So you've probably seen this guy on the news a lot. Yeah, that guy. He's one of the most important people in the world right now here in 2022. This is Jerome Powell, and he's the head of the Federal Reserve, which is under the spotlight a lot right now. Well, with inflation threatening the economy and fears of recession rising, what exactly are Jay Powell and the Fed doing now? In today's video, we'll be talking about what the Federal Reserve does and everything they're doing right now. Let's get started. All right, so what does the Fed do? The Federal Reserve, commonly referred to as the Fed, is the central bank of the United States. It's considered one of the most powerful financial institutions in the world. The Fed performs 5 general functions in order to ensure the effective operation of the U.S. economy and, more generally, the public interest. Number 1, the Fed conducts the nation's monetary policy in a way that promotes maximum employment and stable prices in the U.S. economy. Number 2, the Fed helps maintain the stability of the financial system. This just means they help get the overall system in a place where financial institutions and financial markets are able to provide people and communities with the resources they need to invest, grow, and participate in the overall economy. And there's more. Number 3, the Fed supervises and regulates financial institutions to make sure that they employ safe and sound business practices and comply with all applicable laws and regulations. The Federal Reserve oversees over 5,000 financial institutions. Number 4, the Fed fosters payment and settlement system safety and efficiency. Basically, the Fed helps keep cash, check, and the electronic transactions moving throughout the economy by providing liquidity and services to banks such as transferring funds, collecting checks, and distributing currency and coins. And number 5, the Fed promotes consumer protection and community development. Nearly all Americans are involved in the financial system in one way or the other. So whether that be a checking or savings account, a mortgage, a credit card, or even student loans, you're definitely involved in the financial system. Now, the Federal Reserve's unique structure allows them to effectively implement monetary policy. But how? As the Fed is independent of the federal government, politicians focused on winning elections cannot directly influence policy in a way that benefits their re-election bid over the Fed's primary goal. This independence also makes it easier to enact policies that are politically unpopular, but serve a greater benefit to most people. In summary, the Fed's goal is to make sure that the American financial system is safe, stable, and operating in a way that promotes both maximum employment and price stability. To accomplish this goal, the Fed uses economic data from regional banks to make independent decisions about monetary policy. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. So, I've mentioned the phrase maximum employment and price stability. This phrase is actually extremely important and is known as the Federal Reserve's dual mandate. Everything that the Fed does must effectively promote this dual mandate of maximum employment and stable prices. You're probably wondering, what does it actually mean to promote max employment and stable prices? That's a great question. It's actually a little trickier than you might think, though. According to Investopedia, maximum employment, also known as full employment, is the highest level of employment that the economy can sustain over time. During max employment, almost everyone that wants a job can get a job, and that's key, that wants a job. However, this does not mean that the goal is 100% employment, as this really isn't possible. Measuring what max employment actually can be is quite hard and can also be very hard to measure over time. Because of this, the Fed does not have a set target for the ideal level of employment and will just use data to make policies that seem best for the current environment. Price stability, on the other hand, simply means that inflation remains low and stable over the long run. And when inflation is low and stable, people can hold cash without having to worry too much that high inflation will destroy your purchasing power. As the chair of the Federal Reserve in 2020, Jerome Powell said, "In conducting monetary policy, we will remain highly focused on fostering as strong a labor market as possible for the benefit of all Americans, and we will steadfastly seek to achieve a 2% inflation rate over time." Oh my, how things have changed. So now you're probably wondering, why is the Fed okay with this 2% inflation number? It seems kind of random. They just picked 2%, and where did they come up with this number? This is a great question. It's actually a little bit unclear to economists as well. But here's the best explanation that we could find. Starting in 2012, the FOMC began talking about an inflation target of 2% as they decided that this was the most consistent over the longer run with the Fed's mandate. They explained that 2% would foster price stability and moderate long-term interest rates, as well as enhancing the committee's ability to promote maximum employment. While the benefits of having a 2% inflation target have been debated, the Fed believes that having this target can prevent deflation and keep inflation expectations steady. Keeping inflation expectations stable is actually important because expectations can determine real inflation. As the St. Louis Federal Reserve Bank president, James Bullard, wrote in 2016, firms and households take into account the expected rate of inflation when making economic decisions, such as wage contract negotiations or firms' pricing decisions. All of these decisions, in turn, feed into the actual rate of increase in prices. So this dual mandate of price stability and max employment sounds great, but what tools does the Fed actually have to ensure the mandate is achieved? Interest rates and open market operations. Interest rate tools are simple. By lowering interest rates, the cost of borrowing money goes down, and there is less incentive to save, which encourages people to spend. Therefore, lowering interest rates results in higher spending and lower savings, leading to higher overall economic activity. And on the other hand, lowering interest rates too much will tend to increase inflation, hence 2022. Since the total supply of goods and services is finite in the short term, if there is more demand for that finite set of products and services, prices will go up, hence the supply chain bottleneck. If there is high inflation, the Fed raises interest rates in order to increase the cost of borrowing and raise the incentive to save, which discourages people from spending. This is the exact opposite effect of lowering interest rates. However, if you raise interest rates too much and the cost of borrowing along with the incentive to save both increase, you could end up with a recession as economic activity comes to a halt. Raising and lowering interest rates is a very complex task and can have massive implications on the economy. We'll talk more about this later. The next tool the Fed uses are called open market operations. Open market operations refers to the practice of buying and selling U.S. Treasury securities, along with other securities, on the open market in order to regulate the supply of money that is on reserve in U.S. banks. This strategy can be used to either stimulate the economy or tighten the economy. If the Fed's goal is to stimulate economic growth, it buys Treasury securities to put more cash into the banks. This then puts pressure on the banks to lend that money out to consumers and businesses. And as the banks become more flush with cash, interest rates gradually decline and borrowing becomes cheaper. That's a simple way to explain it, but that's kind of how it works. Now, on the other hand, if the Fed's goal is to slow down an overheating economy, it will sell Treasury securities to pull money out of the banking system. The cost of borrowing will then increase as consumers pull back on their spending and business growth will slow down as the overall economy tightens. Similar to raising and lowering interest rates, increasing and decreasing the cash supply in the economy is a very, very delicate situation. Pulling too much money out of the system could cause an economic slowdown, leading to a recession, while increasing the money supply by too much could cause rampant inflation. Could go either way. All right, so that's the rundown on how the Fed can influence the economy. So what exactly did they do during 2020 when COVID first happened? And what are they doing now to save the economy from runaway inflation? At the onset of the pandemic, the economy really slowed down, and individuals and businesses just spent a lot less those first few months. The Fed injected massive stimulus packages into the economy and decreased the federal funds rate, which is the cost for banks to borrow money from the central bank. By decreasing this rate, the cost of borrowing lowered and increased the incentive to borrow and spend. The Fed also lowered the Fed funds rate by a total of 1.5 percentage points at its meetings on March 3rd and March 15th, 2020. These cuts lowered the Fed funds rate to a range of 0% to 0.25%, which was the first time this was done since the 2008 financial crisis. That's why savings rates went so low. The other thing happening at the time was quantitative easing, which you can think of as open market operations on steroids. From March 2020 to March 2022, the Federal Reserve doubled its balance sheet as it purchased massive amounts of bonds and mortgage-backed securities. And while US GDP decreased by roughly 2.2% in 2020, it increased by more than 10% in 2021. This leads us to the present day here in 2022. Remember the dual mandate we talked about? The maximum employment and price stability? Well, they're not exactly achieving both of these two goals right now here in 2022. When it comes to max employment, it's fair to say that the Fed did a pretty good job here. During the beginning of the pandemic, the unemployment rate shot up from 3.5% to nearly 15%. In just 2 years, the unemployment rate has declined back down to that record low of 3.5%. The Fed technically did its job here. But when it comes to price stability, well, I think you know the answer here. It didn't really work out well. It has not been pretty, and the Fed knows this. In the most recent inflation report, it was reported that prices of goods overall have grown over 9% over the past year, the fastest pace in over 40 years. To combat this, the Fed is aggressively raising interest rates in hopes that it can help bring down demand for goods and services. However, in the process of aggressively raising interest rates, many are concerned that the Fed will raise rates too aggressively and cause a recession in the process. Not many people seem to have faith in the Federal Reserve's efforts to bring down inflation without causing a recession. And in fact, Jerome Powell himself recently acknowledged that there is no guarantee that the Fed can achieve a soft landing, which is fancy talk for a situation where there's no recession. However, recession fears have typically been decent contrarian buying indicators. And while we're not saying that we've reached the bottom, history has shown us that buying during fear usually results in a decent outcome years later. Maybe for investors, that is. And as Warren Buffett says, be greedy when others are fearful. Thank you guys for watching, and I'll see you in the next one.